Good afternoon, everyone, and welcome to today's webinar on income tax amendments, DTAA, and GST or expatriate services. The objective of today's session is to demystify and simplify these three topics related to taxation and international businesses. The session aims to provide a clear understanding of how these aspects of taxation can impact businesses involved in international activities. But before we begin, may I request you all to kindly feel free to post your questions in the chat box and address them to the organizers and panelists only, along with your name and your company name. If you have a certain question directed to a particular speaker, please feel free to mention it on the comments. We express our sincere gratitude to our annual sponsor, UJA Global Advisory, for partnering with us for this knowledge sharing session. UJA was incepted in 1996 as a chartered accounting firm. Over the years, they have grown to become a full-fledged professional firm with a multitude of services such as audit and assurance, international tax, transfer pricing, company secretarial and legal, all being provided under one single roof. They are a one-stop shop for all your business needs. UJA is headquartered in Pune with offices in Mumbai, Bangalore, and Gurugram. They also have an international presence with their own offices in Paris, Milan, and Tokyo. They have an in-house French, Italian, and Japanese desk as well. We have with us today Ms. Olivia, who's based out of France, and her counterpart, Mr. Nitin Krishnan, who's based out of Gurugram. So both of them together handle the French vertical at UJA. Now we will take a moment to introduce our speakers for today. Please welcome Neha Raheja, who's a partner at UJA. Neha is a chartered accountant with 10+ years of experience, and her expertise lies in advising foreign companies structure their transactions in India in the ambit of applicable regulatory framework. She also represents companies before tax authorities at various levels. She also authors articles on thought leadership in areas of income tax and ancillary laws. We would also like to welcome Mr. Yannick Pouplad, Managing Director at Lohr India Automation Private Limited. Yannick is a mechanical engineer with masters in industrialization and management. He has a rich and diversified experience in the automotive industry. Expatriated in Pune since mid of 2010, he has worked with 3 French MNCs here, and currently he's the managing director at Lohr India Automotive, who's a leader in trailer manufacturing. And now, without further ado, I would like to welcome Neha to introduce the topic and begin the session. Over to you, Neha.
Good afternoon, everybody. Thank you, Rucha, for that introduction. And also many thanks to the Indo-French Chamber of Commerce for giving us this opportunity to organize this webinar with them. My name is Neha Raheja, and I am the tax partner here at UJA. So, of course, Rucha has introduced us, but I'd just like to very briefly say that we are a multidisciplinary advisory firm, and our forte basically lies in bringing foreign companies into India, establishing them in India, and thereafter handholding them through their entire life cycle and taking care of their procedural compliances, which are required under various laws. We are headquartered in Pune with offices in Bangalore, Gurugram, and Mumbai. Like she said, like Rusha mentioned, that we also have our own offices in Paris, in Milan, and in Tokyo. My colleagues who are on the screen, so Olivia is based out of France, and Nitin is based out of Gurugram, and they take care of the French vertical here. Similarly, we also have a Japanese desk and an Italian desk. So with this brief introduction, I now dive into the topic for today. So ideally, this afternoon's webinar has been divided into 2 segments. We're going to be covering one aspect of income tax and international taxation, And the second aspect is going to be in the second part of it, we will be talking about GST on secondment of expatriates. Let us start with the first part. So we all know that whenever a foreign company, Rucha, I'm sorry, Tracy, can you have the slide, please? The next one. So we all know that whenever a foreign company does business in India, so it renders some kind of a service to an Indian subsidiary or an Indian company, it derives some kind of a remuneration or some kind of a fee from the Indian entity. Now, this Indian entity could either be its subsidiary or it could simply be an unrelated party. And this fees, which is derived from the Indian entity, is subject to TDS. So you have section 115A of the Income Tax Act. The next slide. So you have section 115A of the Income Tax Act, which provides a rate, which in fact earlier, that was prior to 1st April 2023, provided a withholding tax rate of 10% on payments on payments under fees for technical services and royalties. So that means when an Indian company made payments under fees for technical services or royalty to a foreign entity, TDS was supposed to be withheld at 10%, increased by surcharge and cess. However, when the Honorable Finance Minister, she passed the budget, she came in with a very surprising element. This rate of 10%, she directly increased it from 10% to 20%. Now, this was a huge shock or a surprise which came to us because the withholding, which was initially at 10%, was directly increased to 20%. So it made an impact of 10% directly on the cash outflow. So that means now, when a foreign company would receive money from India, the rate of remittance would be, the TDS rate would be 20% instead of 10%. Section 11, the 20% rule came into effect with effect from 1st April 2023. Section 115A actually states that if any taxpayer if the TDS is deducted under Section 115A for any taxpayer, such taxpayer is exempt from filing its tax returns in India. Now, this ideally was a very big compliance which was exempted to taxpayers in case their TDS was withheld at 10%. But now with the 20% rule coming into picture, the taxpayers now had a choice, or rather were forced to go into and take the beneficial rate under the DTAA. So we all know that India ideally has bilateral agreements with almost all countries. What we call as DTAA is ideally the Double Taxation Avoidance Agreement, and this DTAA has ideally been entered between India and the other countries, only simply that an income, the effect of taxation, the impact of double taxation can be eliminated on the same source of income. So now, and also the Income Tax Act provides that whenever the provisions of the Income Tax Act or the Double Taxation Avoidance Agreement are more beneficial to the taxpayer, they can take the benefit of that particular provision. So therefore, now taxpayers found the DTAA more beneficial. For example, suppose if I were to talk about a French company who is rendering services in India. So now this French company is receiving remuneration or some kind of a professional technical fees, and TDS at 10% was being deducted on this professional fees. Now the rate came up to 20%. So obviously, when I look at the Indo-French DTAA, the rate of TDS is 10%. Therefore, now the taxpayers are opting to apply the provisions of the DTAA, and therefore taxes shall be withheld at 10% instead of 20%. But when we take the beneficial rate as per the DTAA, a taxpayer has to make certain compliances. The first compliance is, of course, the filing of Form 10F, which has now become online, and we will be discussing this in some time. And the second is a taxpayer has to file its tax returns in India. So therefore, the amendment in the rate under section 115A from 10% to 20%, like I said, the taxpayers, if they were availing the section, if they were deducting taxes under section 115A, they were exempted from filing the tax returns. But now, since the rate has increased to 20%, the DTAA rates are more beneficial. And now, if I'm availing the benefit of the DTAA, then in that case, I have to file my tax returns in India. So this is one very important compliance which comes into place and has also increased the burden of compliance on the foreign companies. Can we go to the next slide, please? The second amendment which was actually brought about was the online filing of Form 10F. So ideally, a Form 10F needs to be filed when any taxpayer avails the benefits of the DTAA. Prior to 1st October 2023, the filing of Form 10F was manual. However, this was also another amendment which was brought, and Form 10F has to now be filed online. The government, I mean, this is coming to play, I think, with effect from 1st October 2023. So it's been almost, we can say, 6 months that Form 10F are being filed online. When the initial utility, of course, there was a little ambiguity initially when the form was launched, but now things are getting clear. So as we file a lot of these Form 10Fs, we realize that there are two options. One, you can file a Form 10F with a PAN card or without a PAN card. So for all those who are new and don't know how the Indian tax administration works, a PAN is nothing but a permanent account number, which is the tax identification for any taxpayer in India. So if I have filed a Form 10F online, I can either choose to apply for a PAN card or I choose to file the Form 10F without a PAN card. If I have to file Form 10F with a PAN card, I will first obtain a PAN card. For that, I have to file an application. You'll be issued a PAN card. Thereafter, using that PAN number, I have to create a login on the income tax portal. Thereafter, I have to fill in the Form 10F online. Along with the Form 10F, it becomes essential that we upload the TRC. So TRC is a tax residency certificate. This certificate is basically a proof that you are a tax resident of the opposite country. So in this case, if you are a company incorporated in France, you will obtain a tax residency certificate from the government of France. And this TRC has to be uploaded along with the Form 10F. And lastly, you have to also apply for a digital signature certificate. So you will first apply for the PAN card. Second is you'll file the form online. You'll upload the TRC along with the Form 10F. You will apply the DSC, and then thereafter you will upload the form. And this online form which is generated can then be given to the person with whom you are doing business. Sorry. In the second case, you don't apply for a PAN card. Under this case, if you choose to file Form 10F without a PAN card, then you simply have to, you don't have to do any registration. You have to kind of go online. You have to do a 10F. And at the time of uploading the 10F, at this point in time, you have to fill in the tax identification number of the authorized personnel at the time of uploading Form 10F. Use the DSC and upload the form. Now, this is actually a very, I can say, it's a little surprising that they have enabled the Form 10F utility without a PAN card. Because as per the rules, in case a foreign company is availing the benefit of the DTAA, it has to file Form 10F, which is now online, and it also has to file its tax returns in India. So that means eventually now, okay, I will upload the Form 10F without a PAN. But down the line at the year end, at that point of time, we have to apply for the PAN number and file the tax returns in India. So therefore, it is always advisable. I mean, this is what we suggest, that initially at the time of the application of the Form 10F itself, please apply for the PAN card then go in for all the procedural compliances. Because if you don't apply it right now, you'll have to do it later. Also, just to to bring this to your notice, the government at this point of time, the income tax department is doing a lot of networking and a lot of mapping. So what we believe the government is trying to achieve with the Form 10F becoming online is that they want to see what kind of income the foreign companies are generating in India. And maybe now, of course, we don't have an evidence, neither do we have any data since this is just come online in the past 6 months. There could be a possibility that going down the line for some companies who decide that, okay, fine, we will file the Form 10F, but we will not file the tax returns. These companies going down the line may receive notices from the government for non-filing or non-declaration of their taxes in India. Why am I saying this is that because in the past, like for example, the Black Money Act, which was launched a few years ago, right now, taxpayers and Black Money Act specifically spoke about disclosing certain foreign assets in your income tax returns. Now, for those assessees who have not disclosed their foreign assets, are now receiving notices. So this is coming up almost after 4 to 5 years. So this is, I believe, the objective of the government that going down the line through the Form 10F, they will be able to ideally track those taxpayers who are earning income in India and not filing their tax returns in India. Also, one thing I'd like to say to you here is that in the case of Indo-France DTAA, the rate of 10% under the Indo-France DTAA is beneficial to the taxpayer against the 20%. Therefore, it becomes feasible for the French companies to have this entire compliance procedures to file Form 10F, obtain the PAN, and apply for the DSC and upload Form 10F. But also, what is happening with the introduction of this Form 10F is that a lot of companies are asking. So that means if I'm doing business in India and I'm availing the tax rate under Section 115A, still a lot of companies insist to have Form 10F. And for example, I'm here specifically talking about the Italian companies. So we have a lot of Italian companies, and we realize that this is coming on, these kind of questions are coming to us on almost a daily basis. Because the rate of income tax, the rate of TDS up to 115A is 20%, and the rate of TDS for FTS is also 20% in the case of Indo-Italian DTA. So ideally, they're not benefiting anything. But still, the Indian companies with whom they're doing business insist that they file a Form 10F online. So this probably will be, this may become a norm going down the line that Form 10F will have to be furnished, because unless until this Form 10F is not being furnished, companies are refusing to actually make the payments or process the payments. So with this, I come to the conclusion of the income tax amendments. These were the amendments which have come into the pictures in the last 1 year. And even though they're not very new, but relatively new, but we also see a lot of companies are not aware of this increase in tax rates and also the procedural compliances of filing Form 10F. Now I would like to get into the next segment, which is going to be GST on reimbursement of seconded employees. Can we have the next slide, please? The next one also. So the reason I do understand firstly that we're actually touch basing on two very different topics. The first one, of course, is income tax, direct tax, international taxation. And the second is a totally different field, which is GST. Now, the reason why we decided to do a seminar on both these topics together was that these are very pressing issues and we're getting a lot of inquiries, a lot of case studies are coming up to us. And we realize that there is a lot of ambiguity around both of these topics. So we thought it would be good to address these relevant pressing issues, even though they're completely diverse and different from each other. So let me just run you through this particular segment. Now we all know that very often foreign companies, they second their employees to their Indian subsidiaries. And this secondment is ideally done maybe to achieve some kind of operational efficiency or probably this could be that this employees have some kind of a skill set which is required for the Indian operations here. So very often, Indian companies enter into an agreement with the parent entity or with their overseas group entities for secondment. And also under such secondment agreements, the Indian companies reimburse to the parent company or to the group entity the salaries, the perquisites, the bonuses, whatever such seconded employee receives in the home country. So the Supreme Court, in the case of Northern Operating Systems, has decided that such reimbursements are subject to GST, are subject to service tax in India under the reverse charge mechanism. Now, considering the fact that the service tax law has been replicated into GST and now GST is enforced, automatically GST is becoming applicable under reverse charge mechanism on the reimbursements which the Indian entities are making to the foreign companies. I'd like to very briefly give you the background of this case. So ideally, Northern Operating System was an entity incorporated in India.
Sorry to interrupt. Sorry, Neha. Sometimes your voice is cracking. I don't know where's the mic. Maybe it's only me. Just mentioning it.
Okay, is this fine now?
It's clear for me. It's clear for me, Olivia.
Yes.
Maybe
Okay.
it's clear.
No, maybe it's my computer. Apologize. Sorry, Neha.
Yeah. So just to say that Northern Operating Systems was an Indian entity, and you had certain employees who were seconded from the parent entity to the Indian entity here. Now, under such secondment, the Indian company had complete control on the operation, had complete control on the operations, had operational control on the seconded employee in India. The Indian company had the authority to terminate or conclude the secondment of this seconded employees at any time. The Indian company reimbursed the salaries, the bonuses, whichever were paid to this employee in the home country. And the Indian company was in 100% control of the work which was taken care of by the seconded employees. So this was the facts of the case. Eventually, this case was selected, of course, for an assessment, and it went up to the tribunal level. Now, before the tribunal, the revenue contended that the overseas employer, the revenue meaning the tax authorities, contended before the courts that the overseas entities were rendering a service to the Indian entity. So they said that secondment is the way that such services are being rendered. The Indian company had allotted the work or had allotted the tasks to the Indian company. So therefore, the Indian company had no say on the kind of work which was being done. They had no free authority to choose the work. It was only for the tenure of the secondment, that is for a specified duration, that the seconded employee was on the payroll or on the control of the Indian company. And all the salaries, the allowances, the bonuses, etc., were determined by the overseas entity. So that means this seconded employee was actually the employee of the parent company and not the Indian entity, even though he was seconded here. Now, before the tribunal, the taxpayer, that means the assessee, Northern Operating System, had the contention that the employee, the seconded employee, and Northern Operating System in India were employer-employee relationship. There was no service which was being rendered between both. There was no service which was rendered by the employee to Northern Operating System. Secondly, just because the reimbursement, so Northern Operating System was also reimbursing the entire salary to the home entity, to the parent entity. Just because these reimbursements were made, this does not mean that there was a provision of services. And finally, they said that since the seconded employee has been transferred from the overseas employee or overseas entity to the Indian entity, this is not akin to the provisioning of the service. At the tribunal level, this case was in favor of the taxpayer. However, this case has now traveled up to the Supreme Court, and while deciding this issue, the main contention or the main crux of the entire thing was who is the original employer or who is the real employer of the seconded employee. The Supreme Court held that whatever documents are there, these documents need to be read in totality and we don't need to see them in isolation. Secondly, substance has to be seen, substance over form has to be seen as to who exactly is the real employer of such employee. In the case of Nadin operating system, the employee continued to be on the payroll of the home entity. The salary was also paid to him in his home country. The employer had a pool of resources whom they could second down the line to the Indian entities. And the Indian company derived certain benefits, economic benefits on the deputation of such employees. So ultimately, basis these facts, the Supreme Court contended that such employee, in fact, is under the control and supervision of the parent entity, and only just because for a short period of time the Indian entity controlled the employee, controlled the work of the employee, it did not mean that such employee is such seconded employee is in fact the employee of the Indian company. The ultimate hold or the ultimate control of such employee is in the hands of the parent entity. Thus, by virtue of this, the parent entity is providing services to the Indian entity. So this transaction was called as a deemed supply, and it was held that such transactions will be liable. So whatever reimbursements are going to be paid by the Indian entity to the parent entity will be subject to GST under reverse charge mechanism. Now, after this judgment, we see that the authorities are coming up and are kind of are having several assessments, and a lot of companies are coming under the ambit of this. So there have been representations which have been received by companies, and on account of these representations, the CBIC has finally issued a notification or has issued an instruction in December 2023 stating that the tax authorities, the assessing officers, are required to do a complete analysis of the case. Only after an analysis, they're supposed to see if GST is going to be payable on the reimbursements. The assessing officer by default cannot apply the provisions of Nadin operating case to the assessee on hand, because this is actually becoming, there is undue hardship which is coming up on these Indian companies. Even though the facts may be different, but only by virtue of this decision, there's a lot of hardship which is actually being faced by the assessees. So of course, this is an instruction which has come up in December 2023, but this is not binding. This is not a law. This is only an instruction. Also, this morning I was reading that in February 2024, that means almost a month ago, the Bombay High Court has granted a stay to Mercedes-Benz in connection with the GST, which is to be paid on the reimbursements. But again, one of the grounds for imposing this stay was that the tax authorities need to analyze the case in light of the Supreme Court judgment and see if the facts are applicable, and only then the decision shall be made. So this ideally had come up in February 2024. So again, like I said, that we're actually having a lot of inquiries on this subject, on this subject also, for the simple reason that when secondments are happening, the companies are really being worried as to whether this RCM, this GST has to be paid under RCM or does not have to be paid under RCM. So this is also, of course, one pressing issue, and also just to avoid litigation, a lot of companies are just going suo moto ahead and paying such GST. So with this, I conclude the technical part of the presentation. Can we come to the last slide, please? The second last slide. The next one. The next one. The next one. Yes. So I just like to say that. No. The slide after this. The slide after this. So of course, at the end of the session, we will be taking up questions, but just in case we are unable to take up questions due to the paucity of time, you can basically write to us. We have our email IDs there, and we shall get back to you eventually in due course. So thank you very much for your patient listening, and I hope that this webinar, this knowledge sharing session would be able to help you or help you clear your doubts. With this, now we come to the next segment. So here we have with us Mr. Yannick, who is the MD of Lohr India Automotive. Lohr is ideally the subsidiary of a French company in India, and Yannick has been in India since 2010. Thank you, Yannick, for joining us.
Welcome, thank you.
So very briefly, we'll be discussing with Yannick his experiences about India. So Yannick, could you please elaborate a little about Lohr and its India operations?
Yeah, sure. So as an introduction, briefly, I would talk about Lohr Group. So Group Lohr is a French MNC. It has a global presence over 4 continents, a workforce of about 1,800 people, and a turnover of, say, about 280 million euro as a closing of 2023. And post-COVID recovery is still going on, and we hope to touch 450 to 500 million euro turnover in 2024. That would put us back on track. Lohr Group mostly entertains 4 segments of products. The fundamental and core activity is the trailers, the car carriers, the automotive industry. Second one would be defense applications in the aspect of logistics to support army movements on the ground. Another one is related to railway activities, like typically trucks on bogies to kind of have a green approach to freight. Instead of putting trucks on the road, they come on the train and reach destination with 0 carbon emissions. And a last one, still I would say in the green era that we are getting into, is a new product called Crystal, which is an EV segment, which is a small shuttle to offer to public transport. So when it comes to India operations, we have settled in 2008 here in Pune. Strategically, Pune was the best place elected because it was one to become a very big hub amongst 3-4 automotive hubs in the country. Plus, proximity to Mumbai port made sense also in the case of opportunities for export, which we were looking at some point, still looking at, if we are lucky enough. I would say India also, why we came to India altogether, because it was quite obvious to all that India is a dynamic country and crazily increasing its number of cars sales year after year. So it made sense at group level to enter this segment. And so in India, we focus primarily on the trailer segment, the car carrying, from the OEMs all across the country to all the dealerships of Maruti, Hyundai, Tata Mahindra, and Renault, Mercedes, everybody, because now everybody is there in the market. So that's a fair introduction of the Lohr Group and Lohr in India.
Absolutely. So tell me something. You've obviously worked in France and also you've been in India. So how do you balance the expectations of the French headquarters while dealing with the nuances of the Indian domestic market?
Quite frankly, I would say that probably when we came in India, we would have set the bar a little too high. Maybe expectations was very high in the sense of being overly excited and optimistic to break through rapidly. Of course, the journey has not been that smooth. There have been up and downs, some difficulties encountered, market approval. So I would say the biggest mistake, maybe what we would have done is coming with the idea that we will be able to introduce on the Indian market the mature product which we were having back there in Europe, and kind of ask the market to shift towards this solution, which obviously not everybody was ready for so instantly. So we got taught a lesson by the market. You can't go against this. So we took it a little slower pace and revised our offering, a little less sophisticated, I would say, and step by step brought back over a journey of 10 years all these good ideas which we had on day one. And today the product is really mature and meeting the market expectations with a good amount of education of the customer to help him transition from the old practice, I would say, to a little more efficient approach. So of course, I don't want to sound arrogant there, but when we come from Europe with 40, 50 years experience, and we see in India, there is a scope for improvement. So we thought, back with the dynamism of the country, it is fair to directly jump to the latest solutions available rather than take the long course. So that was the motto behind the lines. And fortunately, in India, I mean, you can be very happy to be supported by the manpower, the operators, the enthusiasm of everybody, a lot of reactivity, willing to do well to catch up with the rest of the world. And at this pace, very soon you're going to overtake, we'll be there, we will overtake everybody there.
Absolutely. So it just took you a little time to adapt and accustom to the Indian mentality. So you actually thought it would be very easy to jump into the Indian markets, but once you stepped in, you realized the reality was very, very different.
True, true. So we always come in with our own processes. So we want to implement, copy paste. What has worked there should work here. But it's just a matter of timing. You need to gauge what is the requirement at this point of time, and maybe take the customer by the hand and say, look, if we do things a little differently, it will be beneficial for you. Even though this solution appears to be more expensive for you today, it has a better return on invest.
In the future.
It makes sense, but it took a little time. We're happy to be nowadays a kind of a benchmark solution for this segment.
That's good to hear. So of course you have worked in France and you have also worked in India. So in your experience, what exactly is the difference in the regulatory framework in France, and how's it different? How's the regulatory framework different in France?
Well, obviously there are quite a few differences. I mean, it can be scary at times, but you're always surrounded with the finance team and people there to tell you how to do and what to do. Main differences, if I had to pinpoint two, I would name the bigger ones, which are the TDS logic, which is not there in France. Even though in the recent years they have brought the TDS concept, but only on employees, so salary related. So that's taxation from the salary point of view, but nothing at corporate level. Second one, and obviously it's a day-to-day activity like the GST. So like you said, I've been there since 2010, so I've seen things moving and transitioning only for the best and the better. It is noticeable that things have been simplified and a lot of homogeneity has been brought across the country, which helps for the interstate billing and all. I come from a time where we were doing billing, there was still the concept of octroi. So octroi, thanks God, has been swept off soon enough, but it was late to my taste. But then we were in the VAT and excise system, which was also having its own particularities depending on the place business was being done. So GST is still complex, but it is more homogeneous and getting better and better over the years.
Yes.
And I think it is also a much safer approach, maybe more bulletproof system also nowadays with this. The portals have gained in sophistication. So now you can cross-check at the back end if your supplier has paid the GST on your name, instead of being trapped and pulled to court unnecessarily in a tax audit. But I mean, we have to acknowledge that India is taking swift moves, and it's only making the country more effective and robust, and helping the fast growth, I think.
Absolutely, absolutely. India is of course improving leaps and bounds, and like you mentioned that we are only getting effective. Yeah, they're introducing new systems like the online filing of and where they want to map, and they want to basically put everyone through this entire system here.
There are things we can learn also, I believe, on the whole continent. I mean, I remember from the latest visit of President Macron, online Paytm, not Paytm, but transaction, Google Pay, UPI transactions, exactly. So it made its own little effect. So there's nothing like we know things better than you. You are so prominent in the IT segment and bringing a lot of awareness across the world. We're happy to learn from that.
So now I just spoke about the amendment in the Income Tax Act, under which the 10% has become 20%. What do you think? What, according to you, is the impact? What is the impact foreign companies? What impact it will make on the foreign companies when they're doing business in India?
But like I said, I mean, India is definitely the place to be right now in terms of business. It's a fantastic place for business to grow. Every component, every ingredient is there. Market size by itself. Money, I mean, a lot of investors, a lot of money available for investment. Material, manpower. Okay, your own strength is also your own population, which creates actually also the market size. So from this aspect, all is good. Now, when it comes to compliances, I would say yes, of course, it's a bit of a serious task there. But fortunately, there are tools, and the ones you have mentioned recently, that DTAA, which will again be beneficial. So these mutual agreements, bilateral agreements between France and India, and not to mention that I think France and India have a tremendous relationship, good relationship, strong relationship. So it would make sense to take the initial effort of getting that PAN card of the headquarters, filling the forms, so and so forms, and whatnot, digital signature, to, at the end of the day, if your company size and business justifies it also, because probably you can bifurcate whether you are a big corporation or a small company having one line transaction per year. You may not find the effort worth. But if you are a sizable company having these relationships with the headquarters and billing of services for a significant amount, of course you would like to optimize your cash flow and not block unnecessarily 20% tax where you could be enjoying only 10%. So everything has to be looked into detail, and it is, I mean, rules are there to normally simplify your life, I hope. And if you pick the right things for the right purpose, it's enjoyable, not that much a headache.
Absolutely. So what, according to you, or is there any particular aspect of the Indian market you find interesting or you find challenging?
Interesting. First, of course, I would say the size of the market. I mean, it looks like today we are looking at limitless opportunities. I think it's difficult to come to India and fail. Having said that, it doesn't mean you come to India and succeed the next day. There is a journey to take. But looking at the size of the business growing year after year, this is the most interesting part about India, for to put us against a mature country like European countries or so, of course. There are so many things to do. If I talk about my line of product, I mean, I like to bring that statistic frequently in my discussions. I had come across some statistics some years back of number of cars per 1,000 inhabitants. So in well-established mature countries, it comes to about anything between 650 to 850 cars for 1,000 inhabitants. I'm talking US market and Europe, for example. In China, to take also a comparison of size of market, there are at, around 180 right now. And India, right now. So, but before, in 2012, there were around 40. And India, at that moment, was around 15, 1.5. So if you say that maybe Europe is an inspiration for India and China is a motivation for India, because you want always to overtake and win that battle. It just shows that there is so much to do. I mean, if you think that eventually everybody would like to be equipped with a four-wheeler, which is a natural expectation for everyone, coming from a bicycle to a motorcycle to a four-wheeler for the family, for the comfort, and thinking that other countries have reached 600 or 700, and we are today at only 15, but now 50 in 2022. So there is still a big step and a lot of opportunities. In terms of challenges, I would say, from my point of view, also, my testimony is a bit from the manufacturing industry point of view, so it's not the service industry. We are on very tight margins. The competition with the local players is also a tough fight every day. But keeping this aside, another challenge is maybe the compliances altogether. But again, all these can be overcome quite easily when you are surrounded with the right people, legal advisors, tax auditors, people who guide you and help you pass any hurdle quite smoothly. So just like UGA is to us for all these aspects, and I thank you for this. It's a place where everything can happen, and I think I would invite anybody to take a chance, because there's a lot to do here, and the market is shareable.
Perfect. Thank you, Yannick. India is certainly a land of opportunities, limitless opportunities, and for the next few years, I'm sure we're going to achieve a lot. So, of course, with that, we come to the end of the session, but not before answering a few questions which we have received. So we have somebody asking us that for CIT that needs to be declared, is it only the income generated with the Indian entity? So when you say CIT, I understand you mean to say corporate income tax. So ideally, any income you are deriving with the transaction from the Indian entity, yes, you have to offer that to tax in India. You have to file your tax returns in India using this income, and this income will be reflected in your Form 26AS. Keeping that as a base, you can file your tax returns. Another one question which we've received is that, what do you suggest? Is it important to obtain a PAN while filing a Form 10F? So like I mentioned to you that though it is not mandatory, you can definitely upload Form 10F without a PAN. But considering the fact that you have to file your tax returns in India at the end of the year, if since you are availing the benefit of the DTAA, it is but obvious that you obtain the PAN. And if you think that you just want to file your Form 10F without the PAN, you can do it, but later on, at least at the time of filing the tax returns, you have to obtain it. So it's to your choice whether you want to do it earlier or you want to do it later. So of course, these were the few questions which you've got, and of course down the line, like I said, that in case you have few more questions, you can reach out to us. We'll be happy to assist you with these, and in case you need a copy of the presentation, also you can reach out to us. We will be happy to share. Thank you very much.
Thank you, Neha. Thank you, Yannick, for a wonderful session. I would just ask if the people present here in person, do you have any questions for Neha, or should we move on to present?
I think but I think
Yes.
everything is closed here and then I missed.
No, it's okay. You can ask the audience who's attending the webinar will then.
So the question I asked was the GST perspective. You mentioned that the GST on the settlement of the employees. But was actually there you mentioned about the Supreme Court's order, you mentioned about High Court order, India order, and then there's a certain instance that CBIC mentioned in similarity has come to another
Instruction.
instruction. The instruction, not law. What is your stand on it? How do you consult compliance and what is the approach you should take on GST? Should they create or should they hold it or?
So we take into account the entire facts of the case. We sit down with them and we ask them exactly what is your agenda, what is your motto, how do you want to structure the transactions. Once we have all the facts available with us, based on that we advise them that is it advisable. So basically we need to see if this is a replicate of this entire transaction in another operating system. If it is exactly like that, of course, yes, we go ahead with the GST payment. If it is not, and if we see that there is a little differentiation point of it, and this can be circumvented, then yes, of course, we would tell them that not to pay. But in most of the cases, the secondment agreements are generally the same. So GST does become applicable.
Right now, it's not 18%.
I think it's 18% under the RCM.
From company's perspective, if you look at the total amount of business that you're doing, it's 18% of one person's salary. They taking the chance of paying the 18% and paying it.
Yeah, that is basically down the line there could be implications. So just to kind of safeguard themselves, they're like, okay, let's
So the operation meeting on the next one.
yes.
One question regarding the same, like in continuation, if we have like the reverse, like we have the reimbursement from the parent company to the company, then is there any law France which is impacting us? Or is it directly the parent company is liable for that?
I'm not very sure of any law in France which would impact us. This is something maybe we can, I can maybe speak to our counterparts there and let you know. But per se, I am not aware of any French law.
Only in India because it is a kind of income to the Indian company.
Yes, yes, yes.
Because right now, like I have seen the cases where taxes are not paid on such reimbursements.
Yes. So as regards to French law, no, I am not aware of this part of it at least.
For Indian companies, like as per Indian law.
As per, you mean to say if the income is derived in France?
Income is actually generated in India because it's reimbursement. So it's a kind of income to the Indian company.
You mean to say if an employee was seconded to France and India is receiving this, any kind of income?
Employee is in India only, but if there is some expenses related to that employee in India, then we ask for the reimbursement to the parent company.
So this ideally we'll have to go into the facts of the case. We'll have to go into it in depth to see whether we need to charge it on a reimbursement or we don't want. We want to show it as income or we don't want to show it as income. For a simple reason that all this is going to be based on interpretations. So based on the facts of your case, we then go into the interpretations which are available under the various under the various case laws. And then basis that we suggest the client whether you need to show it as income or you don't want. A conservative approach would be कि ठीक है आप income दिखा दीजिए, लेकिन a more liberal approach would be no, this is a reimbursement. So there has been an outflow against which there is a subsequent inflow, and therefore this should not be treated as income. All right.
All right, thank you, Neha and Yannick for shedding light on the intricacies of tax amendments, DTAA, and GST on expatriate services. And thank you to the audience for participating in this webinar. We hope it was informative and insightful. We request you all to please fill out the feedback form and survey after the webinar. And once again, a very thanks to all of you and have a great evening.
Good.